As we head into the weekend, the U.S. markets are closed. FuelCell Energy, ticker FCEL, finished its last trading session on Friday, October 31, 2025, at $8.95 a share. That was a significant move, a jump of $1.22 or 15.78% on the day. The stock traded a heavy 15.8 million shares, well above its average, showing a surge of buyer interest heading into the close. Now, the common story, the expectation you'll hear about FCEL, is that this is the hydrogen future. It's the speculative darling, the name that lights up Robinhood and SoFi Invest accounts when clean energy gets a headline. The narrative is that you buy this, hold it, and wait for the world to catch up. But the reality, what that 15.78% jump actually tells us, is far more complex and has almost nothing to do with the long-term hydrogen economy. That move was a violent technical reaction following the company's third-quarter earnings report in September, which, despite a massive net loss, showed a 97% year-over-year revenue increase. The surge we just saw isn't about long-term validation. It's about short-term traders seeing a spark in revenue growth and piling in, forcing a squeeze on a heavily shorted stock. The real question isn't whether hydrogen will power the future, it's whether FuelCell Energy can survive its own balance sheet to be a part of it. Let's dissect that recent price action, because it's critical. A 15.78% single-day gain on a stock that has been in a brutal downtrend for most of the past 2 years is an anomaly. It is not by itself a sign of a turnaround. This isn't NVIDIA stock surging because it just beat data center estimates by billions. This isn't Apple stock rising on record iPhone sales. FCEL's jump was a mix of things. First, the Q3 earnings report back in September was a genuine surprise on the top line. Revenue hit $47.6 million, nearly double the $23.7 million from the prior year. This was driven by a $24 million product revenue recognition from its long-term service agreement with Gyeonggi Green Energy in Korea. The market expectation was continued stagnation. The reality was a large, lumpy revenue hit. However, that same report showed a staggering net loss of $91.9 million or $3.78 per share, ballooned by a $64.5 million non-cash impairment charge. The market initially focused on the loss, but as the weeks went on, the narrative shifted. Traders, likely using platforms with sophisticated charting tools like interactive brokers, saw the stock find a bottom and began to wonder if the revenue beat was the real story and the impairment was just a one-time kitchen sink event. That set the stage for Friday's move. This stock is heavily shorted. When shorts see a name holding its ground after bad-looking but maybe good underneath news, they get nervous. A trickle of buying, perhaps based on that revenue story, can force shorts to cover their positions by buying back shares. This creates a feedback loop, a short squeeze, resulting in the 15.8% pop on high volume. This volatility is a hallmark of stocks with low institutional ownership. When you look at the 13F filings, you don't see Fidelity Investments or major Fidelity wealth management groups holding massive, concentrated positions. Instead, you see a high degree of retail ownership from online investing platforms and index funds. This means the stock is highly susceptible to sentiment swings, a complete contrast to a blue chip held in Fidelity mutual funds or Fidelity ETFs, which provide stability. The Fidelity mobile app might make it easy to buy FCEL, but it doesn't explain the underlying risk. This is a trader's stock, not an investor's stock. So what does FuelCell Energy actually do? The company's business model is built around its stationary fuel cell power plants. These aren't for cars like many assume, they are for providing power to grid operators, universities, and industrial clients. They use a carbonate fuel cell technology that can run on natural gas, biogas, or hydrogen. Their business is split into a few segments: product, selling the fuel cell platforms; service, long-term maintenance contracts like the one in Korea, and generation, where FCEL owns the plant and sells the power. The most interesting part, and the source of the long-term expectation, is their advanced technology segment. This includes a joint development agreement with ExxonMobil to capture carbon dioxide from industrial sources using their fuel cells, a process that captures CO2 while also producing electricity, unlike traditional methods that consume it. This agreement was extended through 2026, which is a sign of confidence from ExxonMobil. The reality, however, is that this is still R&D. It's not a commercial product generating billions. The pilot project in Rotterdam isn't even expected to start until 2026. The company is spending heavily on this and on its solid oxide electrolyzer technology for producing hydrogen. But these are future promises funded by a currently bleeding balance sheet. That balance sheet is the entire story. In its last report, FCEL had $236.9 million in cash and equivalents, but its loss from operations was $95.4 million in a single quarter. Yes, $64.5 million of that was a non-cash impairment, but the underlying operational loss and cash burn are still severe. The company has been funding itself for years by selling shares through an at-the-market offering. This is a continuous, relentless dilution of existing shareholders. In the last quarter alone, they sold 6.8 million shares for $39 million in proceeds and another 2.7 million after the quarter ended. This is why the stock price has fallen so dramatically over the years, even before accounting for reverse splits. Every time the price pops, like it did on Friday, it just gives the company a better price at which to sell more shares to fund its operations. It's a treadmill that is very difficult for long-term holders to win on. This is the kind of critical context that a simple Robinhood app interface or a SoFi robo-advisor might not convey. An investor doing self-investing needs to look past the green energy tag and read the SEC filings. This is where the risk is so different from other tech stocks. People look at Tesla stock and see a company with volatility, yes, but also with billions in free cash flow and a dominant market position. FCEL has neither. It is entirely dependent on external capital markets and government policy. The expectation is that government subsidies for clean energy will create a massive tailwind. The reality is that these subsidies are slow to roll out, and the high interest rate environment makes it extremely expensive for customers to finance these multi-million-dollar fuel cell projects. This macroeconomic pressure is a lid on the entire sector. It doesn't matter how good your technology is if your customers can't get a loan to buy it. This is why a diversified approach, perhaps through Schwab Intelligent Portfolios or other managed investing sites, is often recommended for online investment rather than picking single high-risk names. An intelligent portfolio is designed to smooth out this exact kind of single-stock risk. As we look to the future, the outlook is a stark contrast between expectation and reality. The bull case expectation is that the Exxon carbon capture technology becomes the industry standard, leading to massive orders, or that its solid oxide electrolyzer becomes a key part of the green hydrogen build-out. Bulls see the $47.7 million revenue quarter as the first step in a major ramp-up and believe the stock, now at $8.95, is on its way back to its former highs. The reality is that the company is in a race for survival. The primary catalyst for the next 12 months isn't a technological breakthrough, it's the cash runway. Analyst consensus remains overwhelmingly negative, with an average price target far below the current price, hovering around $8, and a slew of sell or underweight ratings. They are not forecast to be profitable for at least the next 3 years. The biggest risk is not that the technology fails, it's that the company dilutes itself into oblivion before that technology ever gets a chance to become commercially dominant. For someone managing their own individual brokerage account, whether it's at Fidelity, Schwab, or using the Interactive Brokers trading platform, FCEL represents the ultimate speculative gamble. The sophisticated interactive brokers platform might show you the high short interest and options volatility, signaling a trade, but a long-term investment thesis is much harder to build. This is not a stock for a Fidelity IRA. This is not something you put in your retirement account. This is a stock for active traders who understand the technicals and the risk of a 100% loss. I am curious what all of you think about this. Comment below and tell me, do you believe the $64.5 million impairment charge was a one-time event, or is it a sign of deeper problems with their assets? In summary, Friday's 15.78% surge to $8.95 was an exciting day for traders, but it must be seen in its proper context. The market's expectation for FuelCell Energy is a long-term bet on hydrogen and carbon capture. The reality of its stock movement is that it's a financially distressed company, heavily shorted and prone to violent